Hey everybody, welcome back to the StockAbility Startup. Here we are at lesson number 2 now. So last time we talked about trading and investing. Now it's time to learn the language of the market terminology, and also how to read those price charts. We're also going to get into now the chart candlesticks, what they mean, how to use them, and how they give us a glimpse into what's happening really underneath the surface of the market. Check it out. So when I first got into the markets, the thing that confused me was the language, the terminology that I was hearing as well. What's a bull, a bear? And it can be a little confusing for somebody who's brand new to it. So before we even click a button, let's understand the terms used in the markets and understand that language so we can begin to know the environment as well. Now, one of the first things you're going to be learning about through this series of the StockAbility Startup is price. And price action is a key analytical tool that we use within our education to decide whether to go into the market or not. Now, there are 3 stages of any kind of market, and the first stage is going to be the one that most people are familiar with. We call this the upward trend. The next stage we're going to be looking at is the downward trend, when prices are falling. And then sometimes the markets are not going up or down, they're in a ranging pattern or a sideways market as well. Now, you may have heard somebody say, oh yeah, I'm bullish on the market. Well, if you're bullish on the market, that means you believe the market's going to go up. The bulls are having their way if the market's in an uptrend. On the flip side of that, the bears are having their way if the market's in a downtrend. And if we are negative, in our anticipation of the market prices, we would say that we're bearish. If we're neutral, the market's just going sideways, we're indifferent to it. And so, being bullish or bearish on the market is key to the trading decisions that we're going to be making. There are 3 stages in the market structure, and what an active trader needs to do is to adapt the strategy to the market conditions. So with prices moving higher and the market in an upward trend, we focus on buying because we're bullish. This is also known as a long strategy, okay? I'm long the market. Bulls are in control of the market when the prices are moving up. If you're going to take this down to a technical level, what we're really seeing here is greater demand than supply. Those 2 forces of demand and supply, if they're in balance, prices will typically stay where they are. But if demand is greater than the supply, we are going to see upward momentum in the price. Now, on the flip side of this, with prices moving lower, and if the market's in a downward trend, we would focus on selling. Now, you're thinking, well, okay, what do you mean by that? Well, more in future lessons. But if we have a negative downward belief about the market, we would be saying that we're bearish on the market, okay? You might hear the bears are controlling the market in an instance like this as well. And this is where we see that dynamic flipped, where now supply is greater than demand. If the market's ranging or sideways and we're neutral, we're looking to be both buyers and sellers at key times because we're seeing demand and supply equilibrium. Okay, these are the 3 stages. The term bullish comes from, bulls attacking upwards with their horns. Bearish comes from the bears standing up with those large paws and attacking down, if you were just wondering where that little bit of trivia comes from. Now we know about the long position, bullish, the short position, bearish, okay? Let's talk about the candlesticks themselves. How do we understand what is going on a price chart? Now, candlesticks give us open, high, lows, and closes of every time period that we want to track. And it gives us key information that we need to know about price, okay? Helps us make our trading decisions. You're going to get one of 2 candles. You're either going to get a green candle or you're going to get a red candle. And it's simpler than it first looks. The way you would read a candle is the bottom part of the candle is this area here. We call this the bottom part here, is the open price. The top part of this candle body would be the closing price. On the other side of this, the open would be the top of the candle if it was a red candle, the close being lower. So looking at it like this, if a green candle is on your chart, it means it opened low and closed higher. Prices went up in that period. If the candle opened higher and closed lower on a red candle, this means that prices fell during this period of time. You may be wondering what these black lines are at the tops and bottoms of the candles. Well, this shows the highs and the lows of that candle. Likewise, the low and the high of the red candle. And we call these tails wicks, basically. Sometimes you might hear them called tails as well, but typically the terminology we like to use is the wick. So if these are the wicks of the candles, the red and the green components are what we call the bodies. Something to remember here is a candle represents a period of time, guys. As a trader, you need to specify what that period of time is based upon your trading goal and your style. A candle could represent 1 minute of trading. It could represent a week of trading. It could represent a whole month of trading. So you're going to use different styles of candles, or should I say different periods of candles, depending on the style of trading that you're going to be doing. Let's kind of dive in here and actually take a look at what a week tracking candles may look like. So let's say we start the week and prices open just around here. Now notice when a candle first starts, it's just a dashed line, guys. Okay, price hasn't yet moved. In the trading session, prices move higher. Now as prices move higher, at the end of the day we close, and we close at the highs of the day. The very next day, we open higher than the close. But immediately upon the open, bears start to put pressure on the market, driving prices down. We close at the lows for the day. See, now we have a red candle. Now, on the next day, the prices open somewhere in between, and we get some bullish price action first, and then the sellers come in during the period of trading, pushing the price back down. Now, notice how this has left a tail, because this is like a shadow of where prices was, and then the price moves down a little bit lower and we close at the lows. Now notice how the candle looks different this time. One large wick and a very small body. We never know what a candle's going to look like. It could be all different styles. Remember, it just starts with an open. We don't know where it's going to close. The wicks are useful because they show us where the trading went to and where the price went to. This is why they're also called shadows. The next day the price is open. And what do we see? A major sell-off in the first part of the day. Bearish price action. Then during that period of time, buyers step in, start pushing the price back up, and then we close higher than the open. Now notice, because we close and trade higher than the open, the candle automatically turns green. So now we have another bullish candle here. On the very last day of the week, we open. What happens? Prices move higher, and then again during the period, the sellers come in, push the price down, and we end up putting in a brand new low for that day. But late in the day, the buyers step back in, and the market closes at exactly the same price as where it opened. A neutral day, if you like. This is what we would call a doji. Now on the Monday, we can see that we had bullish price action. The Tuesday, bearish price action. The Wednesday was also a down day, so again, bearish. The Thursday would be bullish. And then was the Friday? Yeah, neutral. The price opened, went up, came back down, and closed at exactly the same price. It's a neutral day. So if we track this as a Monday through a Friday, we can say we opened low, and by the Friday we did close higher. The difference between the weekly open and the weekly close resulted in a bullish week, reading those candlesticks. Let's now bring it all together. Let's look at some different styles of charts. Let's take a stock that we're all familiar with here, Microsoft. The ticker symbol is MSFT. The chart that you see in front of you right now has time along the bottom, we talked about this in our last session, and price along the right hand side. And it's a chart ranging from 2008 to right now today in the early part of 2020. Notice the upward trend. This is a bullish chart that we talked about. Now in this example, every single one of these candlesticks represents 1 month. So we notice here this green candle opened low, closed near its highs, incredibly bullish. Look at this candle at the moment. See how we opened, we went higher, but now the price has been pushed all the way back down. So this is one of those dojis, an indecisive candle right now. Now these candles are going to take a long time to form because they're monthly candles. They're not going to be moving too quickly, okay? So we would be looking at a chart like this if we were longer term traders. Now if we take the same chart and we take it down to a slightly smaller time frame, now we have a weekly chart. Every one of the candlesticks represents 1 week of time on Microsoft now. See how we still have an upward trend, but we also, because we've gone to a smaller time frame, we can see this sell-off and this rally here as well. Remember, every one of these candles will take a whole week to open and then close. If we take this now down to a daily chart, again, we're looking at a slightly different picture of price action now. This market's looking more like a ranging pattern. Yes, we've had upward trend, downward trend, and upward trend again. Every one of these candles represents a day of time. And if we were watching this, we'd actively see this changing in real time. Finally, we're going to take a look at the 4-hour chart. And again, this shows us a completely different picture. One candle represents 4 hours of time. And we can take this all the way down to a 15-minute chart, a 5-minute chart, a 1-minute chart. Why would you use a 4-hour chart? Maybe because you have a shorter term style of trading. We've looked at Microsoft from 4 different angles here. The candles and the way we read the candles is the same. We use different time frames depending on our styles of trading that we're going to use in our strategies. The charts and candlesticks give us basically market and price perspective, and they are going to be a key tool to help us decide when to get in, when to get out, and how to build our strategy and manage our positions moving forward. So now we understand a little bit more about how to read a price chart and a candlestick. The next step is looking at how this relates to us when we actually place trades and we actually put our hard-earned money at risk. Risk control and profit taking, a huge subject, something we're going to be covering in our next lesson. I'll see you next time.